Well, folks, pull up a chair. I'm an old man now, 94 years young, and I've been doing this investing thing for longer than most of you have been alive. You see a lot of things come and go in nearly a century, but the fundamental truths, they don't change much. I've made my share of mistakes, and boy, have I learned from them. Some of those lessons were expensive, costing me billions of dollars in opportunity. But I always figured if I could learn something useful, it wasn't a complete waste. I remember back in 1962, I started buying shares of Berkshire Hathaway. Now, most people know the name Berkshire Hathaway today, but back then it was a New England textile mill struggling mightily, clinging to an industry that was rapidly heading overseas. I was what you might call a cigar butt investor in those days, a disciple of Ben Graham, my professor at Columbia, who taught me to look for cheap stocks, then believed in buying companies for less than their liquidation value, like finding a cigar butt with one last puff left in it. And Berkshire on the surface looked like a pretty good cigar butt. I bought more and more of it, eventually gaining control. The company was run by a fellow named Seabury Stanton, and we had a bit of a disagreement. He offered to buy some of my shares at a certain price, and then he reneged on the deal, offering me less. That really got my goat, so I decided to buy control of the company just to fire him. What a bonehead move that was, driven by emotion. It felt good at the moment, but it wasn't a rational business decision. What I should have done, what any sensible person would have done, was to take the money Seabury offered, even the lower price, and put it into something with a future. Instead, I poured good money after bad into a dying textile business. We kept trying to turn it around, investing millions into new machinery, trying to compete with cheaper labor overseas. But it was like trying to teach a pig to sing. It wastes your time and annoys the pig. We eventually closed those textile operations in 1985 after losing money for 20 years. If I had just taken the capital that was tied up in that failing business and put it into, say, a good insurance company back then, Berkshire would be worth billions more today. I've estimated it cost us something like $200 billion in opportunity cost over the decades. It's hard to imagine, but it's true. Here's what I learned from that mistake: the hard, painful way. You see, Ben Graham taught me invaluable lessons about value, of buying a dollar for 50 cents. But what Charlie Munger, my partner, really hammered home was that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The textile business was a fair company at best, and it was in an industry with no sustainable competitive advantage, what we call a moat. A moat is like a castle's protective ditch, making it hard for competitors to attack. It could be a strong brand, a low-cost production method, or high customer switching costs. The textile industry had no moat. It was a commodity business, and every dollar we invested to improve it just went down the drain. We were trying to swim upstream in a powerful current. That's why we shifted our focus at Berkshire. We started looking for businesses that could naturally generate increasing profits over time, businesses that didn't need constant capital injections just to stay afloat. This philosophy became central to everything we did at Berkshire. Instead of cigar butts, we started looking for exceptional businesses with strong moats managed by honest, able businesses that could raise prices without losing customers, or that had a unique position in the market. You don't need a Harvard MBA to understand this. Just think about what makes a good hamburger stand. Is it better ingredients, a prime location, a beloved brand, or just really good service? All of those can be moats. It reminded me of a time in the 1970s when Charlie and I bought See's Candies. We paid $25 million for it. Now, people thought that was a crazy price for a candy company, but See's had something special. It had 100 years of goodwill, a strong brand in California, and people loved their chocolates. They would pay a little more for a box of See's for Valentine's Day or Christmas because it meant something. That's a moat. See's didn't need much capital, and it generated cash year after year. The initial $25 million investment has now returned us over $2 billion in pre-tax profits over the years, without counting the initial purchase price. And it taught us that pricing power and a strong brand are worth their weight in gold. That's the kind of business you want to own. Contrast that with Dexter shoes, another mistake I made in the 1990s. We paid $433 million for it, and it turned out to have no sustainable advantage. The market was flooded with cheaper shoes from overseas, and we lost all that money. It was a huge mistake, and I could have used stock to buy it, but I used Berkshire shares, which meant I exchanged valuable Berkshire equity for a business that disappeared. I issued Berkshire stock for that one, which is like trading diamonds for an empty box. When we bought a major stake in the Coca-Cola company in 1988, we applied those same lessons. Coca-Cola is one of the most powerful brands in the world. It's a simple product, but it's global, ubiquitous, and it has a unique place in people's minds. People want their Coke. It has that staying power, that intangible asset that makes it special. We paid about $1 billion for our initial stake, and it's been one of our most successful investments. That $1 billion investment is now worth many, many times that. Plus, we've collected billions in dividends. Charlie and I were sitting in the office in Omaha back then talking about what makes a business truly great. We realized that while Ben Graham taught us to buy cheap, Phil Fisher, another great investor, taught us to buy quality, and Charlie helped me combine the two. We wanted quality businesses, but at a reasonable price, not necessarily a dirt cheap price. And we wanted to hold them for a very long time. Our favorite holding period, as I always say, is forever. If you're a young investor today, or even an old one, here's what I'd tell my younger self based on these experiences. Focus on understanding the business. If you can't explain what a company does in a few simple sentences, don't invest in it. It's really quite simple, folks. You don't need fancy math or complex algorithms. You need to understand the underlying economics of the business you're buying. People think you need to be a genius to succeed in investing, but that's just not true. I've seen people with 60 IQs fail miserably because they lack temperament. What you need is a sound intellectual framework, patience, and the ability to control your emotions. Don't let the daily gyrations of the market dictate your actions. The market is there to serve you, not to instruct you. It's like Mr. Market, a manic depressive partner who shows up at your door every day offering to buy or sell your shares at wild prices. You don't have to listen to him. You just say, no thanks, Mr. Market, if his price isn't right. This applies to any business, not just investing in publicly traded stocks. What really matters in business is finding something that provides true value, something that customers want and will keep coming back for, and doing it efficiently. It's about building a reputation, delivering on your promises, and having a cost advantage or a unique product. Whether you're running a lemonade stand or a multinational corporation, the principles are remarkably similar. Take Geico, for example. We bought the whole company in 1996. But no, I had first invested in it back in 1951 after meeting Lorimer Davidson, who worked there during my time studying under Ben Graham. Ben was the chairman of Geico at the time. Actually, I was so impressed, I put half my net worth into it. I later sold it for a good profit, but it turned out to be one of my dumbest decisions. Was you dumb to just hold on? Eventually, we bought the whole company. It's a low-cost provider of auto insurance, direct to the consumer, a powerful economic model that allows it to consistently offer better prices and still make a good profit. That's a moat built on efficiency and scale. But that's not the only lesson I learned the hard way. This reminds me of another time when my emotions got the better of me, and it cost Berkshire a pretty penny. It was in the late 1960s, a period of speculation, what they called the go-go years. I was running my partnership, the Buffett Partnership Limited, and things were getting wild. The market was going up for no good reason. People were buying stocks based on height, not value. I found fewer and fewer opportunities that met my criteria for value and margin of safety. I was looking for dollars for 50 cents and people were paying $2 for a dollar. I knew it was dangerous, so I started returning capital to my partners, ultimately deciding to dissolve the partnership. And I couldn't find enough cheap stocks to satisfy my investment principles. I felt like I was being forced to swing at pitches outside my strike zone, and that's a sure way to strike out. The truth is, it's often what you don't do that makes you wealthy. I sat out a lot of fads, a lot of speculative bubbles. People called me old-fashioned, told me I was missing out, but I stuck to my knitting. I learned from my dad, who ran a stock brokerage during the Depression, that you have to stick to your principles, especially when things get crazy. He taught me the value of a dollar, and he taught me to be patient. I delivered newspapers as a kid, saved every penny, filed my first tax return at age 13 from my paper route earnings. That discipline, that understanding of value stayed with me. Ben Graham's concept of a margin of safety is perhaps his most important contribution. It means buying a business for significantly less than its intrinsic value, giving you room for error. It's like building a bridge that can hold a 30,000-pound truck, but you only plan to drive 10,000-pound trucks across it. You have that extra cushion. That's what we always strive for at Berkshire. We don't want to stretch for a price. We want to be greedy when others are fearful and fearful when others are greedy. I remember vividly when American Express got into deep trouble during the salad oil scandal in 1964. A warehouse receipts company, Allied Crude Vegetable Oil, that American Express had insured, turned out to have tanks full of seawater, not salad oil. American Express faced potentially massive losses, and its stock plummeted. Everyone was panicking, selling off shares of a fundamentally sound financial institution because of a temporary, albeit significant problem. Charlie and I saw it as an opportunity. We didn't know exactly how much they would lose, but we knew the American Express brand, its traveler's checks, and its credit card business were incredibly strong. We spent weeks investigating, even standing in front of the American Express office, counting how many people were still using their traveler's checks. We saw that the core business was intact and that the long-term value wasn't destroyed. So we poured a significant portion of the partnership's money, about 40%, into American Express stock. It was a contrarian bet, and it paid off handsomely. We bought it at a time when others were terrified, and we wrote it back up. This story really illustrates the power of independent thinking and conviction. You have to be able to think for yourself and ignore the noise of the crowd when everyone else is running one way. Sometimes that's precisely the time to run the other. But it has to be based on a rational assessment of value, not just a contrarian whim. We understood the business, we assessed the risk, and we saw a large margin of safety. My reading habits are a big part of this. I spend 80% of my day reading annual reports, financial statements, newspapers, books. I read hundreds of annual reports every year, not just of companies I own, but of their competitors, their suppliers, their customers. It's how I build my knowledge base, how I refine my circle of competence. My office in Omaha, that hasn't changed much in decades. It's not filled with fancy computers or Bloomberg terminals. It's filled with books and papers. The circle of competence is a critical idea. You don't have to be an expert in everything. You just need to know what you know, and more importantly, what you don't know. I famously avoided investing in technology companies for many years because I didn't understand them. What seemed clear to me was that their competitive advantages were often fleeting, and their business models evolved too quickly for my comfort. Now, some folks will point to our investment in Apple and say, Warren, you went against your rule. And you know what? They'd be right in a way. But I didn't invest in Apple because it was a tech company. I invested in Apple because it became a consumer products company with an incredibly sticky ecosystem and brand loyalty. People love their iPhones. They don't just use them, they live in them. That's a powerful moat, not too different from Coca-Cola's brand, just in a different package. Tim Cook is a brilliant manager, and the business had predictable earnings and cash flow. It wasn't about the latest chip. It was about consumer behavior and a powerful brand. that fits my circle of competence. Charlie always tells me that it's okay to change your mind when the facts change. And the facts about Apple as a consumer platform were compelling. It reminds me again of how Charlie broadened my thinking from just cigar butts to wonderful businesses. He hammered home the idea that a truly great business can be worth paying a fair, even generous price for, because its earnings will compound over time. Compound interest truly is the eighth wonder of the world. Albert Einstein might have said that, and he wasn't wrong. This philosophy extends to how we manage Berkshire Hathaway itself. We built it into a collection of wonderful businesses run by outstanding managers, guys like Ajit Jain, who runs our insurance operations, and Greg Abel, who oversees our non-insurance businesses, are simply exceptional. We give them autonomy, we trust them, and we let them do what they do best. We don't meddle. We want our managers to think like owners, because that's what they are in spirit. When we hold our annual shareholder meetings in Omaha, sometimes we have 40,000 people show up. A shareholder once asked me, "What's the secret to finding good managers?" And I told them, look for someone who loves their business so much they'd do it for free, but they won't because they're too good. It's about passion, integrity, and competence. You want people who are honest, hardworking, and intelligent in that order. I often get asked about my lifestyle, living in the same house I bought in 1958 for $31,500, driving my own car, eating my C's peanut brittle, and drinking cherry Coke. It's not about being cheap. It's about doing what I love and not getting caught up in the trappings. My real joy comes from building, from seeing our businesses succeed, and from seeing people benefit. I've always believed in living within my means, and more importantly, in doing what makes you happy. For me, that's reading, thinking, and playing bridge with friends like Bill Gates and Charlie. And speaking of Bill, he and Melinda really changed my thinking about giving. I always knew I'd give away my fortune, but they showed me how to do it in a way that truly impacts the world. Now, 99% of my wealth is going to philanthropy, primarily through the Bill and Melinda Gates Foundation. It's a wonderful feeling to know that the capital generated by these great businesses can go on to do so much good for humanity. It's another form of long-term compounding, but for societal benefit. I also believe in never borrowing significant money for investing. I've always said that if you're smart, you don't need it. If you're dumb, it'll kill you. Debt amplifies both gains and losses. If you're using leverage, a few bad decisions, or even just bad luck can wipe you out completely. The stock market is already volatile enough without adding more risk with borrowed money. Sleep soundly, folks. Invest within your means. I write the annual letter myself, I sit down and try to explain things clearly, honestly, and with a bit of humor. It's my chance to talk directly to our partners, to explain our philosophy, our successes, and our failures. It's about transparency and accountability. That's why I'm always brutally honest about our mistakes, like those textile mills or Dexter shoes or even Tesco, where I got greedy and lost a chunk of change because I bought more when the stock went down without fully understanding why. What a fool I was for not paying closer attention to the business's fundamentals there. After 94 years of doing this, here's what I know for certain about building wealth that lasts. It's not about extraordinary things. It's about doing ordinary things extraordinarily well, consistently, over a long period. Focus on businesses with enduring competitive advantages run by honest and capable managers and buy them at a fair price with a margin of safety. I could tell young investors one thing, it would be this: start early, learn constantly, and be incredibly patient. The biggest advantage you have is time. Let compounding work its magic. Don't check the scoreboard every 5 minutes. Focus on owning pieces of great businesses, not on trading stocks. I'd never bet against America. This country has an incredible ability to innovate, to adapt, and to overcome challenges. The free market system, while imperfect, is the greatest engine of prosperity the world has ever seen. Invest in America, invest in businesses you understand, and have faith in the long-term future. You don't need to be brilliant. You don't need inside information, and you certainly don't need a high IQ. What you need is temperament, patience, discipline, and the ability to think independently. Learn from my mistakes, learn from Charlie's wisdom, and never stop reading. Remember Ben Graham's core wisdom: an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. It's really that simple.